And on today's show, what are the tax advantages for a captive insurance company? Part 3 of this week's series on captive insurance companies with author and expert Wes Sirk. Welcome everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Hey, welcome Wes, day 3.
Day 3.
Well, we're talking about day 3 here, and today we're kind of going to walk through, we did this at the end of the show, we kind of gave the generic difference between I'm just self-insuring and I'm a captive insurance company. Two different animals. And you just gave one idea, which was a tax issue. And everybody always asks me, well, Steve, is this about taxes and so forth? And remember, it's not just about this. And when you're talking about a person who's a high producer like Wes is, we're talking about top of the table, Form 400 producer. These guys are looking at things in a lot bigger scenario than the granular CIC. We're not just stuck on captives. But I want to kind of talk through it because you have been doing this for such a long time. And yesterday, if you missed our show, we talked about why advisors should be into this. And Wes's company has been into it. So how long have you guys been doing captives now?
We did our first one in 2002.
So it's been over a decade. I want to tell you to talk about, give me some differences. Now, we talked about tax differences yesterday. Walk me through the yin and yang, kind of give me the tale of two cities, self-insured versus CIC.
When you are a self-insured group, the main thing we were talking about yesterday is you take a deduction for the claims that you pay. So if you were at $1 million a year in premium, you paid out $500,000 in claims. In self-insured, you can only deduct that $500,000. Now, if you were a captive insurance company, you can actually pay the $1 million to your own captive. And when you pay the $500,000 out in claims, you still have those reserves that are sitting there in order to pay additional claims later on. So that's huge.
But they're writing off the full $1 million?
Correct.
Okay, so that's the thing. You're really setting up a separate entity that is a insurance company, and that insurance company is actually whatever's funding for that year, that is a complete write-off.
Correct.
Oh, wow. See, so that's the first disparity is the tax issue.
Yeah.
What's the next disparity or the difference?
A lot of people ask me that. A lot of business owners say, well, isn't this just deductible self-insured? It is, but another major thing is when you are in self-insured, most clients go out and get a specific deductible plan and an aggregate stop loss. So if you were, for example, let's use health insurance or even workers' comp. You could get a specific where you're taking the first $100,000 and then the aggregate stop loss may be at $1 million. Mm-hmm. So you buy that. When you're a captive insurance company, keep in mind, that is a retail product versus reinsurance. Mm-hmm. And most people think, oh, I have reinsurance at this amount with my self-insured. It's not, it's a retail product. Now, when you're a captive insurance company, you have the ability to go and access the reinsurance market.
So you're bypassing the retail insurance label.
Correct. So reinsurance is insurance for insurance companies. So if you're a licensed, regulated insurance company, a captive, then you can go out and buy reinsurance. It's almost the difference between buying retail versus wholesale. Mm-hmm. And there's huge cost advantages in doing that.
The disparity between the retail and the wholesale market going direct to reinsurance as a legal captive is, again, we're not even talking about claims and profitability here. We're talking about actual price tag to back up. I still have to have insurance. I'm just using the reinsurance direct.
Correct.
So that disparity, that savings off retail is substantial.
Yeah, 15 to 20%.
Off the top.
Off the top.
So right away, claims or whatever, deductions or whatever, I'm already buying it at a discount.
Correct.
Give me another reason. What's another kind of a difference between a captive insurance company and just self-insuring?
Well, captive insurance company, when you get a reinsurer involved, remember reinsurers have been in the market for a long time. So having the ability to have a reinsurer there with you, a captive, you can control your own claims. You can control the payout. You can hire the attorneys to fight the claims. But in a self-insured environment, you're kind of left to your own devices. It's good to have professionals because remember, reinsurers, those are the people that really know the game. They have the ability to bring in years and years and years of experience to actually help your captive be more profitable and bring in the best risk management techniques where if you're just your own self-insured entity, you may not have that.
We come back from the break. I want to talk about the tax advantages of a captive. Now, we've given the generic. I want to now walk through some specific areas, some items that we can talk about that really could be, I think, head turners for a business owner. We'll be right back after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to the second segment. Of course, we're with captive insurance company expert Wes Sirk. Wes has two books that are out on the street right now, and again, you can go right out to Amazon.com and get these. Is Taking Captive and You Can Make It, But Can You Keep It, which is my favorite mantra of your title. We're talking about tax advantage. Now, we've already cited some of the big ones. So, self-insured is one thing. You only got to write claims. But in this, when we fund a fully captive and legal, we have to file with the state first.
Correct.
Now, there's some expenses to this. So that's going to be a write-off. Right, correct. We're going to have attorneys involved. And if we're going to play in different states, we have to file in every state. Is that correct?
Depends on the structure of the captive.
Mm-hmm. So if I'm a standalone, I want my own captive, I'm not sharing in a pool of other smaller captives or whatever. When I do that, I'm talking about my expenses to set up the captive. I have to fund the captive. Now, if that's coming out of my corporation's money and I get to deduct that. When I go ahead and do that, what am I putting this kind of, I already got the deduction. I'm thinking, shouldn't I be in conservative? I thought when I first saw captives, I said, oh, it should be conservative. Maybe they're in government bonds. They look like an insurance company's portfolio. But then I heard you start, oh no, there's mutual funds in here. You have to talk a little bit about the mix and why we're investing. We're making money while we're waiting for claims to occur. I mean, that's what it sounds like.
Correct. That's what insurance companies do. They take in dollars today to pay out claims in the future, and they get to live on the float. Mm-hmm. And that float gets to be invested in many different things. When you have a captive insurance company, depending on the domicile you set it up, they have their own requirements. But most of them are wide open, where you can invest in many different things. A portion of it has to say in cash or cash equivalents, muni bonds, government bonds, something that's safe, secure, and fungible, which is what the insurance regulators want to make sure. And
there's a degree of liquidity that they have to park day one. What is that? What do you think that ratio is, would you say?
I tell clients conservatively 25 to 33% of the premiums they put in.
All right, so let's say we're conservative, we put in 35%, we're in liquid government bonds, we're doing money markets, whatever is liquid we can. But now I want to move up the food chain a little bit, and because I'm going to watch how my company works, I'm going to be very good and mindful about my liabilities and try to keep my risk and my actual claims experience down. I can go into whatever else I want to go into, whether it's funds, ETFs, it doesn't matter.
Correct. Something that you can trade. We have clients that use mutual funds, individual stocks, aggressive growth. Some of them are in REITs. Mm-hmm. Once you get through a period of time, think of your auto insurance. You buy auto insurance January 1st, it expires January 1st. And at that point, when that policy expires, that money moves over to the capital and surplus, excess capital and surplus of your insurance company. Now that's their money to play on because you didn't have any claims. It's the same thing with a captive. Once you move the money over to capital and surplus, you have a lot more freedom. And we have clients, the IRS says you can't loan money back to the entity that took the deduction. That's very clear. That's one of their cardinal rules. We have clients that go out and create another LLC and they loan money from their captive over to that LLC to go and buy real estate. Or they create a leasing company and they'll loan assets from their captive to their leasing company and go and buy equipment that they can then use in their traditional business. And they charge normal lease terms and everything's done and there's loans between. So you can get really creative. You can use them to, you can create a factoring company.
No, I took the deduction, but now if I'm gaining a return on my portfolio, am I paying the conventional taxation on that?
You pay taxes. That's an insurance company pays taxes on its investment earnings.
So you'd have to do the same.
Correct.
And I know some captives use high cash value and early high cash value contracts. Mm-hmm. If it was inside, if you were doing indexing or you were doing separate accounts, you would have the same protection in a conventional life insurance contract, would you not?
Correct.
So do people look to that sometimes as well?
Sometimes people do. Now there has to be a reason. Because I get advisors that ask me about high cash value life insurance all the time. And I say, as long as there's a reason to buy the life insurance, you need it for buy-sell agreements, you need it for estate planning, you need it for some reason other than the agent making commission on it, then it's fine. So, With a business owner, there's always the need to have life insurance, and that's properly structured. It's no different than COLI or BOLI.
Would it be to his advantage also if he has a regular indemnification need, as you've suggested, buy-sell agreement and so forth, but he also doesn't want to pay taxes on the earnings, or he wants to at least mitigate some of that instead of having it in the open market with a mutual fund or an ETF where he's subject to capital gain or ordinary income?
And sometimes they're subject to those taxes whether or not they sell, because the mutual fund can sell off stuff and give them a phantom tax liability, even when they haven't done anything.
So he could move out of 1099 land and put it over maybe into an insurance contract. But you're saying the big thing you're looking for is I have to have real indemnification reasons first. Then if there's a supplemental tax advantage to it, that's kind of gravy on the entire meal.
Correct, exactly. There has to be a need for it.
Well, that's all the time we have for today's show. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our site, downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.